Good morning, everybody. Welcome to the Inter-American Dialogue. Thank you very much for joining us. We're going to get started. This is just an hour session, and I know there's a lot of interest, and there's a lot of ground to cover. So the dialogue is very, very happy to be working again with the International Monetary Fund in launching their report, the Regional Economic Outlook report in Washington. This was launched, in Bali, at a meeting in Bali, just a month ago or something like 2 weeks ago. Sorry. And the idea of this session is to do a launch of the report here in Washington and to get a sense of what the region's economic outlook looks like for this year, and of course looking ahead to 2019, which is it's a complicated landscape, and there are many factors to consider. But we thought it would be useful to have a presentation of the main findings and also a discussion with all of you to answer questions about what's happening. The title of the report is An Uneven Recovery, which gives you some sense of the thrust of the study. And it covers a wide range of different variables, both global factors as well as domestic issues. And as you'll hear, the situation is quite complex and a bit sobering, although there are some bright spots that we'll get to that we're not going to ignore here. We're delighted to have with us Krishna Srinivasan, who's the Deputy Director of the Western Hemisphere Department at the International Monetary Fund. He will make some opening remarks to try to put this report in some context and frame the discussion. And then we'll be delighted to hear from Jorge Roldós, who's the Deputy Director of the Western Hemisphere Department at the IMF, who will give a brief presentation, a PowerPoint presentation of the study, and then we're going to engage in a good discussion with all of you. So with that, let me invite Krishna, if you would like to come and make some remarks.
Thank you, Michael, and to the Dialogue for hosting us this morning. Just to put this report in perspective, usually we have two reports in spring and annual and fall, coinciding with the spring meetings and the annual meetings of the IMF. Starting this year, we have gone to a different format where in fall, we'll just do an update of how we see the regional economy, and in spring, we'll do a full-fledged report with all the analytical chapters and so on. Now, just to give a little bit of background on how we see the region, Latin America and the Caribbean, if you recollect, in April, we actually saw some green shoots. We thought things had turned around in the region, and things were looking better in some of the big countries. And that was in April. But not long after that, we saw a bout of volatility in emerging markets. We saw a lot of developments in the region, which have led us to a situation where we have an uneven recovery. So some of the larger economies which were doing slightly better in April have actually regressed in terms of performance, and that explains why we see a recovery which is uneven. So some of the larger countries like Brazil, Argentina have regressed in terms of how they've performed. Mexico has moved sideways, whereas some other countries like Colombia, Peru, Chile have done better. So that it kind of tells you what the recovery is uneven. And in the Caribbean, things are looking slightly better because of the impetus being provided by the U.S. economy. So in terms of key messages coming out of our discussions in the regional economic outlook and in the context of our meetings in Bali, the first, of course, is recovery is becoming more uneven. And in fact, Jorge will show you a chart which tells you exactly what we mean by that. And activity in some large economies is slowing and even coming to a halt in some ones where, in some cases, growth is in negative territory. Now, going beyond the outlook and talking about policies, what we see is in response to the shock which this region faced in terms of commodity prices collapsing and so on, many countries have adjusted in terms of fiscal consolidation. Despite that, primary deficits in many countries are well above debt stabilizing levels. In other words, there is a problem with debt, there's a problem with fiscal, which continues to be addressed and needs to be addressed going further. So which tells you that in terms of providing support to the economies, fiscal policy, there's not much room there. There's not much space for fiscal policy. And if you remember in April, we talked about how inflation was coming down in many of these countries, and that was opening up space for monetary policy. But what's happened since then is with higher energy prices, there's been an impact on inflation. In addition to that, there's been a lot of movements in currencies. A lot of currencies have depreciated, which again limits the room for monetary policy. So compared to where we were in April to now, monetary policy space has also declined in many of these countries. So what does it leave us with? So exchange rate flexibility is a key tool which countries need to use, and they have been using. Many countries have been allowing the exchange rate to move so that they can respond to the shocks, and so that's a key policy instrument. But going beyond that, given where we are, and given how long-term prospects in Latin America are so uninspiring, this is the time to start embarking on structural reforms. Many countries have started doing that, but I think this is where there's need to be greater impetus, because going beyond the short term, long-term prospects in Latin America are pretty uninspiring. In fact, Jorge will talk about how growth is so low in per capita terms. So with that as a backdrop, let me give it to Jorge to present the thing, and I'll be happy to answer questions after that. Thank you.
Should I click? Huh? Oh. There you go. Okay, thanks Krishna, and thanks Michael and the dialogue for hosting the event. In terms of the global backdrop, let me give you 30,000 feet view from our World Economic Outlook. We have been saying that global growth is projected to remain relatively steady in 2018 and 19. 3.7% is the magic number. That was the growth in 2017, and we're projecting the same growth for 2018 and 2019, which is a downgrade of minus 0.2% relative to what we had in April. And this is related to a relatively slower growth in the advanced countries, mainly in the euro area and Japan in the first half of the year, and due to the increasing trade tensions in 2019. What is important to take from this chart is basically that we believe that growth in the advanced economies has peaked in the first half of this year and is going to slow down going forward. Now, that means that external demand continues to remain relatively supportive of the recovery. The red line on the left chart is basically the demand growth in the main trading partners of the different countries in the region. And you can see it's around 4%. So the recovery is still there, okay? And also in terms of commodities or commodity prices, we see that they have bounced back from the trough in early 2016, and they are a relatively high position now, but we're expecting them to slowly come down in the medium term. So all in all, we see global cross currents, and you see that the growth is solid now, but it's going to be slowing down going forward. Now, financial conditions remain accommodative for most of these countries. Despite a blip earlier in the year, you can see that corporate and sovereign spreads remain at relatively low levels, 200 basis points and 300 basis points, respectively, and equity prices remain elevated. So that's the positive sign. Now, the negative is that capital flows have subsided quite a bit since the first quarter, and we are seeing now that they are actually in negative territory. If you look at the chart on the left, here we have portfolio flows, both equity and bonds, and you see the purple line for 2018. It has a peak in April, and from then on, we have had outflows, so we are already for the year to September is in negative territory. It's not as bad as 2015, where we have the sort of the volatility with the Chinese yuan and more impact on emerging markets overall, but you can see that compared to 2016 and 2017, the capital flow picture is not that encouraging. And actually, as a result of that, is that we have been further depreciation in the currencies in the region, as you can see in the chart to the right. So that's the global or external backdrop, if you want. In terms of domestic issues, policies have been relatively supportive. As Krishna was saying, most countries have their real policy rates in slightly accommodative territory. Okay? If you look at the chart, with the exception of Mexico, which is the first country on the chart on the left, the red dot is basically the policy rate minus the expected inflation. You can see there that all other countries, the red dots are below the black intervals, which are our estimates of what is supposed to be the neutral policy rate. So it's slightly accommodative in Colombia, still accommodative in Chile. Brazil is way below the natural or the neutral rate. So conditions are there, but the prospects, as Krishna was saying, are not great going forward, in the sense that we have depreciations and increases in the price of oil that and increases in U.S. interest rate that give very little space for further loosening should the region hit some bumps. Now, on the right, you have a measure of the fiscal impulse, and if I can focus your attention in the last line of the table, you can see that for 2018, we see a mild fiscal expansion in the region. This is mostly driven by an expansion of 1% in Brazil and half a percentage point in Mexico, for different reasons that we can discuss later if there is some interest. But for the region overall, fiscal policy is mildly supportive this year, but we expect it to tighten in 2019. Again, not a massive amount, but overall for the region, the aggregate is a negative fiscal impulse. Okay. So with that global backdrop and the domestic conditions, we have the following outlook for the region. Okay, oops, went too far. Mildly supportive global conditions and domestic as well underpin what we call a moderate or an even recovery. But we see divergent outcomes across the region. We are seeing growth at pretty much the same rate as last year, 1.3 last year. We have 1.2 expected for this year GDP for the aggregate of the region, and 2.2 for 2019. This is a non-trivial cut from the April forecast, where we had 2% for this year and 2.8 for 2019. And that is driven, as Krishna was saying, basically because of a slowdown in the largest economies of the region. Okay. You can see that Brazil is at 1.4 this year and 2.4 next, coming down from close to 2% in the previous forecast, and this was due mostly to a big strike in the transport sector that they had in May, June of this year. And it's important also to note that Argentina faced a severe volatility during the summer, and that led to substantial revision of the program, as well as a cut in growth to minus 2.6% this year and minus 1.6% next year. So if you put it all together, the three largest economies in the region are growing less than we expected, or contracting, as in Argentina. And a similar thing can be said about Mexico and Central America. There's a slight growth reduction in Mexico, as well as Central America, and the Caribbean is more or less even between the commodity exporters and the tourism-dependent economies. Now, as Michael was saying, there is always some brightness in the forecast, and that comes mostly from the Andean countries. You can see Chile, Colombia, and Peru in green. That means that we have revised the forecast upwards. And we have Chile growing about around 4% this year, Colombia accelerating to 3.6 hopefully next year, and Peru growing above 4%. So the driving forces for this mild and uneven recovery is mostly domestic demand. And as we have been saying for a couple of reports now, we are seeing and hoping to see a stronger recovery in investment. There, the chart starts in 2014. We have all the components of aggregate demand, and you can see the red is investment, and we had 3 years of negative investment growth, 14, 15, and 16. Little of investment growth in 2017, and despite the fact that we have had these corrections in growth in Brazil and Argentina, there is still investment, signs of life in private investment in the region, and we expect that to firm up a little bit more next year. Consumption is going to contribute a little bit less to growth this year, but still is a large component, so it does weight. And consumption in the region is basically supported by relatively resilient conditions in labor markets, both in terms of employment and real wages. So that's our baseline. In terms of risks, we see a number of risks, and we should say that overall, risks are definitely tilted to the downside. And I'm going to focus basically on 4 of the risks: 2 domestic, the tightening of financial conditions and the escalation of trade tensions, and 2 domestic risks, political, as well as spillovers from Argentina. Okay, so on the external side, super sensitive. The chart on actually the message is that if there were like I said before, we have seen a small tightening of financial conditions. If we were to see a further tightening, this could have significant implications for growth in the region. The chart on the left shows financial conditions indices for the largest countries in the region, and you can see the 0 means neutral financial conditions, below 0 is expansionary, above is contractionary or tight financial conditions, if you want. And the dots are the current outcomes in terms of financial conditions. This is a bunch of indicators in terms of spreads, leverage, and other financial indicators. You can see that most countries are very close to 0. That is, financial conditions are accommodative. And the light blue lines is a 1 standard deviation of that index, okay? Which is a shock that could happen, for instance, if we were to see a 10% appreciation of the US dollar vis-a-vis the major currencies. It would be a large shock, but not as large as what we have seen during the Lehman crisis, which are the yellow bars on the tightening territory. So again, a relatively mild financial condition shock could have an important impact on output, and that's what we show in the chart to the right. And say we take the first country on the right, Brazil, in a horizon of 1 year, we would see that financial tightening shock to lead to a contraction of GDP of -1%. So if Brazil was going to grow at 2.4 next year, this tightening would shave 1% growth from Brazil. So the risks are there, and they could have a major macroeconomic impact. Now, the second risk is an escalation of trade tensions. This is a chart that we borrow from our sister publication, the World Economic Outlook, and it has a lot of information, so let me give you the bottom line. The chief economist used to call it the hamburger chart, because it adds layers of trade measures and counter-trade measures or retaliation from other countries. So the blue line, if you focus on the world and the US and China on the top, the blue line is tariff measures that have already been imposed Okay, these are the steel and aluminum, the 50 billion on China, retaliation from the US, 200 billion from the US, retaliation with 60 billion of imports by China. And that, as you see, has a relatively mild negative impact on the US and the world economy, a somewhat larger impact on China. Now to that, we add the red line, which is the addition of tariffs on the rest of imports to the U.S. from China, which is 267 billion. And that has a similar pattern to the blue line, just a little bit deeper recession. Now, the next layer is the addition of restrictions on cars, trucks, and parts. And that, as you can see, has a much stronger impact on GDP, especially in the US and China, and not trivially in the lower part of the chart, in the middle, for the US NAFTA trading partners. Now, the likelihood of this happening is lower now that the US, Mexico, and Canada have agreed on the USMCA. So maybe you have to skip that layer. Which leads me to the bottom left chart, which is more of what we would expect for the region, the G20, including other emerging economies. And you can see the green light that pushes activity further into negative territory is a result of confidence effects. That is, if trade tensions continue to escalate, businesses are seeing increasing costs, reductions in revenues, more uncertainty, and that would bring growth downward, and that could certainly have an impact in the region. Moreover, the last one is a market reaction, sort of a negative risk aversion that pushes negative growth in emerging economies to minus 1.2%. So this is clearly a risk for the region. It's not a direct risk from the imposition of tariffs. It's an indirect risk from the impact on uncertainty and tightening of financial conditions. Finally, on the domestic side, one risk is the spillovers from Argentina that, again, in terms of direct effects, would affect mostly Paraguay, Uruguay, and Bolivia, whose exports are more than 15 of whose exports are to Argentina. For the other countries, and in particular Brazil, is not that big of a shock. On the right-hand side, on the right axis of the chart on the left, you have the share of GDP of exports to Argentina from those countries. And you can see that for those three countries I mentioned, exports to Argentina around 15% of the total, or 3% of GDP. I mean, the crisis in Argentina is not going to kill totally those exports. It may put some damper on those. So it will have a direct impact, but mostly with the closest trading partners. The impact is lower, much lower actually for Brazil. But again, the risk that we face is that events in Argentina don't go as well, then financial conditions can tighten, and that may lead to indirect effects for the rest of the countries. In terms of the political calendar, the upper part of the right-hand side chart gives you sort of the elections that we have already had, that is Colombia, Mexico, and Brazil. And I would say that in Colombia, we have a clear idea of the new authorities' intentions and policy indications. But in Mexico, both Mexico and Brazil, we don't have already the administrations in place, and there is still substantial uncertainty on what they are going to do. Both have expressed very good intentions, but we have to see what happens in their actual budgets and activity and other measures of economic policy. The rest is a number of elections in smaller countries, and finally in October we have the elections in Argentina. So political factors are going to continue to have an impact on the outlook. Finally, on policies, as Krishna was saying, there isn't much if we were to get hit by one of those shocks, there isn't much in terms of policy space. On the fiscal, as you see in the chart on the left, the blue line is the decline in revenues of the governments related to the collapse of commodity prices. Okay? And you see that the yellow bar is where we are now. Okay, so Chile, Colombia, and Peru have made some effort in recovering the lost revenues, but other countries haven't done that much. And in the case of Ecuador and Trinidad and Tobago, the losses were so large that even though there is effort from those countries, still, as Krishna was saying, primary deficits are too high and need to be corrected. Which means if you move to the chart on the right-hand side, the purple one, for the whole region, we need to close probably around 2 percentage points of GDP in terms of primary deficits to get closer to what would lead us to declining levels of debt. So all in all, as I was saying at the beginning, the recovery is with us. It's a little bit uneven, but commodity prices are probably as high as we're going to see them in the next 5 years. So it is a time to try to make some further efforts and rebuild fiscal buffers. In terms of monetary policy, again, as we said before, there isn't that much space. Now, going back to the fiscal, we believe that the fiscal is critical not only for financial reasons and debt sustainability, but also in terms of growth. We try to look a little bit more carefully to the gap that Latin America has relative to other emerging markets in terms of investment. And you can see on the left, the blue bars, Latin America invests on average in the last decade 20% of GDP, whereas the number is closer or above 23% for other emerging markets. So that means that we should be trying to make a further effort on investment. And why is that we have such low investment? Well, we have run some regressions on what's called the Felston-Horioka puzzle, and it's very clear that low savings rates in Latin America have a lot to do with low investment. Okay, so an effort to increase savings is definitely necessary in the region. And in the last chart, you can see that public savings, which is savings from the government and public enterprises, is much lower in Latin America than in other emerging markets. Latin America saves around 2% of GDP relative to 3.7% for other emerging markets. So increasing government savings, that is reducing deficits, is definitely going to help with investment and growth, which is the ultimate objective of policies, because, as Krishna was hinting at, the prospects for per capita growth in the region are relatively dim. Okay, as you look, if you see the chart on the left, the red squares are what we expect GDP per capita growth to be in the region over the next 5 years, and you see it's a 1.9%. compared to an emerging market and developed economies average of 3.6. Okay, so we have ways to go to engage in a process of convergence towards the advanced countries. And I just mentioned a few what are the obstacles on investment, but also the region has been showing declining numbers in terms of total factor productivity. And as Krishna was saying, this time around we don't present analytical chapters. We're going to be working on this issue, on issues of why is that the region has such low productivity. And already we have some results that demonstrate that a high misallocation of resources can be behind that low total factor productivity. And with all, that's all I had to say, so I'll let you open for questions. Okay.
Start the discussion now. Unfortunately,
Thanks, Michael. And it's always a pleasure to comment on work from our colleagues, our sister institution, as it were, over on 19th Street. And there's so much that we agree with. It's kind of embarrassing, but it would be very boring of me just to repeat all the things that we agree with. So what I'll do is I'll just make some specific comments where I think maybe we have a slightly, perhaps, a disagreement's probably too strong a word, but at least some nuances in perspective or something like that, we could say. The first point I wanted to make, though, was that as has been remarked, the heterogeneity of the region and the current variance in growth forecasts is I think, at an all-time high. If you look at just the dispersion of growth rates, and even if you take out Venezuela, which is clearly an extreme on the wrong side, I think that's also true. I mean, the variance of current growth rates for this year and projections for next year is kind of at an all-time high, at least in the I should explain, the IDB we don't do growth projections. We leave that to our more intelligent friends over on 19th Street. We do sort of what-if analyses and other analyses, but we leave growth projections to the IMF and the World Bank and others. So let me turn to a couple of specific points that I wanted to make. So both Krishna and Jorge mentioned the value of floating exchange rates, and that's clearly been true. Our exchange rates have been, at least for the major economies that have inflation targeting regimes and flexible exchange rates, have been extraordinarily flexible. And to the extent where I would say that they may have even overshot on occasion. So what happens is you get a negative shock and then exchange rates depreciate quite dramatically in some cases. That hasn't had a big impact, a positive impact on exports. At least it seems to have taken a long time to feed through to exports. But some of my colleagues at the IDB have some interesting work showing the quite robust effects on domestic production and sort of import substitution. So there have been great benefits on import substitution. But of course, you know, when you get such a large depreciation, although pass-through to inflation has not been high, there has been some pass-through. And so inflation has risen, and in several cases, inflation rose above the relevant inflation target. And central banks, they intervened, and actually there's a very interesting recent book by the IMF on the experience of foreign exchange intervention among inflation targeters, which is not always considered a sort of heterodox thing to do amongst inflation targeters, but it's a very interesting set of chapters there in a recent book that the IMF has produced, and in some cases the central bank has also increased the policy interest rate, and people get very worried about this because they say this is pro-cyclical monetary policy. You know, and it's clearly pro-cyclical interest rate policy. That's clearly the case because it was all as a result of some negative shock, like the fall in commodity prices. I think we've been a little bit more generous, let's say, in thinking about this in the sense that, you know, I think that if inflation does go above the inflation target, then there is a fear that inflation expectations become de-anchored, and so central banks may have been correct in some cases to have done that. To protect the credibility, as it were, of the anchor. We all agree, I think, that better communications on this is a plus and should be enhanced. And now, as Krishna pointed out, in most cases, or Jorge, pointed out, in most cases, monetary policy is now supportive, and one could argue that this stock of credibility, if you like, that has been gained, at least in some countries, is now assisting in the fact that monetary policy is now more supportive going forward. Let me make a quick comment on the fiscal. I'm you know, it's interesting, the fiscal impulse, as Jorge mentioned, the fiscal impulse, but in fact, countries are adjusting. So it's a bit more like countries are adjusting less than they might have been before. And in fact, many countries in the region are adjusting, and it's quite extraordinary. Perhaps I haven't really checked this, but it could be one of the periods where more countries in Latin America are actually pursuing fiscal adjustment than in many cases in the past. And the adjustment plans are, in our macro report that we published in March, we had an analysis of countries' plans. So countries' plans over about the next 4 years or so for those that have more medium-term strategies is actually for an adjustment of about 2% of GDP, at least it was in March. We haven't updated this as yet. But that's not enough to keep debt stable. So debt will continue to rise. The relatively good news, however, is if one looks at the kind of structure of this adjustment, we have been arguing, and I think the IMF has as well, that this adjustment really should be on things which have low multipliers and not on capital spending, which one thinks has a larger growth multiplier. So if you cut capital spending, it's not necessarily going to be so good because it's going to hit GDP as well as the fiscal. So if it hits the numerator and the denominator, then it may not even work. And actually, if you look at countries' adjustment plans, they have shifted more now to planned cuts in consumption, government consumption, rather, which we think has lower multipliers compared to government capital spending. So that's I mean, your glass could be half full or half empty because it's still cuts. Unfortunately, there's about 2.2% of GDP cuts planned in capital spending, but it's certainly that's a lot less than it was before. Now, countries, again, are in very different positions. Some countries have large public sectors with a lot of tax revenue. Other countries have much smaller government sectors. So what countries want to do in terms of cutting spending or increasing revenues depends on their starting positions. And in fact, in general terms, we think that countries are more or less have that correct in terms of the way in which they're thinking about adjustment. And then I should also plug our, and forgive me for plugging, our flagship, which has just come out. So this is our 2018 flagship, which is on government spending. And the sort of headline figure is that if we could just improve the quality of public spending, there are huge benefits to be made. 4.5% just in terms of efficiency gains, 4.5% of GDP, and perhaps another 0.5% of GDP in planning infrastructure spending better. So a headline number could be, 5% of GDP in terms of potential in improving the quality of public spending. Let me turn, and I take up 2 more minutes. Sure. On the risks, we agree, I think, with the risks. So I won't spend a lot of time there. I mean, I think the trade tensions clearly could become quite serious. Those are significant numbers. If that came about, that would have an impact on Latin America, particularly growth in China, which impacts Latin America, particularly through commodity prices, as China is such a demander of commodities. Commodity prices are not low by any historical standard. Actually, according to some work I've done, real commodity prices now are roughly at the level that they were between the 1920s and the late 1970s, before the collapse in the 1970s. And so we're well above 1980s and 1990s levels, even if they have come down from the peak that they were at. So it's not as if we're in a period of particularly low commodity prices, where I'd say these commodity prices are certainly, by historical standards, they're in a medium range. And I think, what the thing to say about commodity prices, we don't know what's going to happen to commodity prices. They're extraordinarily volatile, particularly oil. And oil, of course, is very important for several countries. So countries really have to think about how to manage the uncertainty in these prices rather than trying to think whether commodity prices today are high or low. And finally, final comment and also on the risks. We completely agree about the financial risks. Hopefully monetary normalization will go smoothly and is according to plan, and there are no shocks. But clearly, there could be bumps along the way. And if there is a unexpectedly higher inflation in the U.S. and interest rates move higher than is planned, then this could certainly have an impact on our asset prices and on capital flows, etc. And final comment on growth, which was in fact the focus of our macro report in March of this year. We certainly agree with the diagnosis that we because of these risks, in fact, it would be great to think of ways of boosting growth as a hedge against these risks, but also just to boost potential growth in which if one looks at the projections, are relatively low. And, you know, we need to do better both in terms of investment, the level investment, and in terms of the efficiency of that investment or productivity. And countries are in very different positions. So, you know, there are some countries in the region that have relatively good savings and they have relatively high investment numbers. In fact, there are a couple that have very high investment numbers. And so for them, it may not be so much boosting investment, but it may well be this misallocation issue that Jorge mentioned and which was a focus of our analysis in March. I mean, to a large degree, we are economies of small firms. There's a large tail of small firms in many countries. Those small firms tend to be less productive than large firms. And these unproductive small firms appear to persist. They don't, you know, you would imagine that if they're unproductive and not profitable, at some point they should exit, and the profitable ones should grow and become large firms. And that doesn't seem to happen. So there seems to be something that's preventing this from happening. We think that we need to think much more about tax systems and the design of tax systems. We think that some countries even have tax regimes which give benefits to small firms, so they stay small. For example, there's some evidence for that, where tax enforcement is not perfect. Enforcement, of course, if I was the tax collector, I want to focus attention on the large firms where I get most money, and so enforcement may be less. There may be less enforcement on small firms, so their effective tax rates are somehow lower. And also the design of our social security systems, which often are financed through labor taxes. And if they're financed through labor taxes, then this is an incentive for firms to be informal, or even if they're formal, to hire informal workers. And informality seems to have some correlation with productivity. So there are micro things that we really need to think about. And then there are definitely some countries where investment is low and domestic savings is low, and we agree with Jorge that the domestic savings is a serious constraint in some places. And you know, we may need to think of other more creative ways of tapping external finance to finance infrastructure and long-term investment, because if one looks at how most long-term investment is financed, it's through domestic finance, but very restrictedly so. And we had an analysis of what we should actually do to boost growth, and you can look at the website where our macro report is, and there are a set of what we call country development briefs, so country by country, what the right interventions might be. But the things that crop up there are, I think infrastructure is mentioned 15 times, so in 15 countries, infrastructure is viewed as one of the key issues. And financial markets or savings, trying to boost savings, is also mentioned about 15 times. So I'll stop there, but thank you very much. It was an enjoyable read. Thank you.
Thank you. Thank you very much, Andy. Appreciate those good comments. And I think what we're going to do is sort of devote the rest of the session, since the time is limited, to your questions and comments, just so that we get some good participation, and then we'll come back to our colleagues for their responses. So if you could just please, we'll start with you over here, but if you just please tell us who you are and where you're from, and wait for the microphone, because we're webcasting this. Thank you.
Hi, Alberto Hart from the Embassy of Peru. Thank you very much for the presentation. In terms of capital flows, I'm wondering to what degree are you seeing sectorization of these? I'm thinking about the case of my country, clearly skewed towards metals, and to what degree that could pose a risk vis-a-vis the next commodity cycle. You mentioned that they're pretty stable now, so wondering about that. And in terms of trade, also given Mr. Powell's presentation, to what degree do you see uncertainty as a greater or lesser risk than U.S. Fed policy tightening in terms of the effects in the region? Thank you.
Great, thanks. Yes, another Peruvian. A lot of Peruvians.
Yeah, that's right. Luis Alberto Salgado, I'm a lawyer, human rights lawyer. To which extent does inflation is real bad, or at which point inflation begins to be bad? Paul Krugman, Nobel Prize economy, says that we shouldn't be afraid that much of the word inflation. Of course, I'm not referring to the inflation in Venezuela, craziness, aberrant inflation, or other countries in certain circumstances. But to lay people like me, could you tell us to which extent inflation is bad? And the second question, if you allow me, does the IMF at some point consider the situation of human rights in connection with efficiency or efficacy of the economy? To which extent violation of human rights affects the economy in the short, middle, or long term? Thank you.
Thank you. Yeah, we go to...
Hi, thank you so much. My name is Sergio Martinez. I'm originally from Guatemala, and I am a former projects officer of the Monetary and Capital Markets Department at the IMF. So I'm wondering, I wanted to ask you a question about capital controls and financial repression. We are 10 years after the global financial crisis, and we have seen over the years that many countries, including emerging markets in Latin America, are coming back to these kind of policies. I'm wondering if you anticipate potential macroeconomic and financial effects coming from ceilings to interest rates, quality of banking supervision, and capital controls. Thank you.
Other questions and comments? Anybody? Yes. We go to Ruben.
Thank you. Good morning. Thanks for doing this. My name is Ruben Barrera. I'm with the Mexican news agency Notimex. I have a question on Mexico. The last speaker, well, not the last, but the previous for the last, says that the IMF has still some uncertainties regarding Mexico. He also mentioned Brazil. It caught my attention, that comment, because a couple of weeks ago, Alejandro Werner says that the IMF, they expect that Mr. López Obrador, in the case of Mexico, he will maintain the economic institutional framework. So I was wondering, you can, develop a little bit on what are those areas where, what are those areas just to be the source of this uncertainty on the case of Mexico? Thank you.
Okay, thanks very much. Why don't we go back to our speakers? I just have one brief question, if I could just add to the mix. It's just on the chart that looks at the growth rates and the bright spot being some of the Andean countries. I think I saw that Colombia is projected to go up to increase conservative, but Chile, your projection for decline, if I'm not mistaken. And is that wrong? That's correct. Right. And to the why is the okay. 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 Fine. So why don't we turn to first Krishna for any thoughts about these questions? You just turn it up. Yeah.
So let me take a few questions, and Jorge will take the others. Yeah, I'll take the easy ones. So on a point which Andy made about commodity prices and so on, I'd like to make one comment. One is we're seeing commodity prices, clearly they are not low in sense. One thing which we worry about is when China continues to slow, when things slow down in China, and China continues to rebalance away from investment to consumption-led growth, that could have a structural impact on demand for commodities from China to Latin America. So that's something which Latin American countries have to internalize going forward. So even though commodity, and that may be a dampening effect on growth going forward. So that's something which we need to look at. Particularly for metals, because agriculture's consumption will be related. The other point, which again, just to touch upon, on fiscal, Andy, you had mentioned about capital spending. I think a lot of the adjustment which has happened so far has been effective on capital spending. Going forward, they may have intention of not doing that, but so far it's having on capital spending, and that again is a drag on growth. So those are 2 points I wanted to make. So that also goes to the issue which you raised on Peru, how we see. So there's an impact on metal prices, which could be, more durable than what we see right now, and that could affect capital flows going into Peru. There was an issue on human rights and efficacy. We don't look at this issue ourselves. We do look at the risks emanating from that. but we don't look at the impact of growth coming from human rights abuses and things like that. We leave that to our friends like the IDB and the World Bank, just to give, I think. There was an issue on uncertainty in Mexico. I think Alejandro was right in saying that the incoming administration has committed to fiscal discipline and so on. So that, in that sense, we are quite reassured by what they're doing and so forth. But in terms of what I think Jorge was talking about is, yes, they have reached a deal on the trade thing, but it still needs to be finalized and signed and sealed. So there is an uncertainty still there, which is there, which we have to see how the deal finally is signed and sealed. So that's what I think Jorge was talking about. You can correct me if I'm wrong. On the issue of inflation, I think we start worrying about inflation when things get unanchored, right? And the thing is, Latin America, there's one thing which has really worked very well in the last 20 years is how much they have brought inflation down. So to the extent that inflation starts rising and expectations start becoming unanchored, that is really worrisome for us, right? And again, Andy made a point which we talked about in terms of, these countries being ahead of the game and trying to make sure that inflation expectations don't get unanchored. That's why we say that, how they've done monetary policy is important. And the issue which we talked about in communication is equally important, which again, we've done some work last year on communication. And I think it's important for central bankers to communicate how they see inflation expectations, how they see a policy tying into those developments. So that's where we come from.
Actually, since you are in inflation territory, I'm going to respond to one of the points that Andy made. There is a lot of debate on the procyclicality of monetary policy, but the simple view is that we are having a slowdown, so countries should be lowering interest rate to stimulate activity, right? But that forgets the fact that when you are dealing with economies that are open to international capital flows, many of them rely on those flows, and we have seen, for instance, rates in the US go up by 2 percentage points, and these countries have been able to lower them. Okay? But in any case, the conditions in capital markets do impact monetary policy decisions, and despite having an inflation output trade-off, you also have to take into account in these countries the capital flows dimension, if you want. In terms of the fiscal, yes, it is sort of a positive stimulus this year, but in the context of a medium-term adjustment. Since we do our projections carefully, we have to notice that, for instance, Mexico in 2017 did a fair amount of adjustment because of a one-off transfer of funds from the central bank to the government, and that means that not having that one-off this year means that you are to some extent expanding. Okay. Then on the specific questions, sectorization of capital flows. What I was showing is mostly portfolio flows, that is flows that go to bonds and equities. We continue to see relatively robust foreign direct investment flows, and in particular to commodity sectors, since commodity prices are at a relative peak. If you look forward, there is still a healthy amount of foreign direct investment flowing to the region. On the question as to whether trade tensions could have some relationship to the monetary policy tightening in the U.S., we don't think so, because the Fed knows that these are probably one-off cost push effects that they should overlook in their interest rate decisions. Finally, on inflation, I agree totally with Krishna that you have to make sure that inflation is well anchored, but there were some studies on inflation many years back that look at inflation and growth, and whenever you go beyond a threshold of 5, 6, 7%, definitely higher inflation is negative for medium-term growth. So it's definitely, even in countries that you do not have a well-established inflation targeting regime, definitely high inflation is not good, mostly because of the impact on planning and investment for businesses. On capital controls and repression, we don't see much of that in the region now. And definitely there has been a lot of progress. And, the fund has changed views a little bit on capital flows, and sometimes we think that they can be used for macroeconomic intent, but not under very, very, very strict conditions. But we don't see a major use of those instruments in this juncture.
Thank you. Peter had one final question. Maybe we can get him if there's anybody else, if we just have a few minutes. Also, what is the current projection for Venezuela inflation from the fund?
2.5 million.
2.5 million?
2.5 million, yes.
For this year?
Once you
go beyond this, right. It doesn't make any difference, right?
So it's just to have a reference point of view.
Okay. Well, the thing is that everybody cites the IMF on inflation. They cite different figures. So I want to know what the correct figure was. Thanks. Peter?
Hi. Let me ask, the title of the report is Uneven Recovery, which implies recovery. And I agree with you that it's uneven recovery, but it's the big countries, the wealthier countries, that are all at the bottom, and the small countries are at the top. And it sounds to me like a better title, just to sort of, would be uncertain recovery. Because the big countries also have very much to do with the health of the economies of the small countries. And I just wonder, why did you choose that topic, that title, rather than uncertain recovery?
It's a good point, and we struggle with both the poetry and the economics of the issue. And if you look at the numbers, we had 1.3 growth on average for the region last year, and 1.2 this year. Okay, and 2 going forward. And previously we had 1.3 to 2, which would have been a normal recovery. But still it's a recovery because we're growing. We had the trough of negative growth in 2016, so it is a recovery. Now, the fact that it is uncertain is quite true, and that is being captured by the fact that we see risks tilted to the downside. Okay? So to be fair, we talk recovery in the baseline, and the uncertainty is more related to the bias towards downside risks.
And Peter, to your point, every time we do our reports, we have a competition within the economists for a title. Okay? And the complicated... No, we don't go to the poets. I mean, and the complicating factor here is we have to see how the translation also looks in Spanish. So we've had some issues in the past where we picked a title which looked very good in English, poetic in English. We translate that in Spanish, it looks pretty bad. So we have to choose our title based on a number of considerations, but democratically done.
Thank you. Well, I encourage the next time looking for a title to consult Peter. He's very good. He's our go-to guy at the Dialogue for titles on any subject. So anyway, this has been terrific. I want to thank Krishna, and I want to thank Jorge. Andy, thank you so much for providing some great comments. And thanks to all of you. There are copies of the report. If you haven't seen it outside, there are only 8,000 left, so you better rush and get one while they last. But anyway, and we'll look forward to your report in the spring. And hopefully we can have a follow-up then. Okay, we'd love to continue to do this. So thank you all very, very much. Thank you.